And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And I will tell you this, I was reading some reports on what the S&P 500 is doing, what the NASDAQ is doing, what the Dow Jones Industrial Averages are doing. And for the most part, they seem to be doing pretty well. They seem to have recovered from the conundrum that they went through over the last couple of years, and they seem to be trading effectively at new highs. So many of you are out there thinking, wow, this is it. We finally have done it. We finally have crashed through overhead resistance, and now sky's the limit. So many of you that are investing in 401ks, many of you that are investing in IRAs, many of you that are putting money into these government-sponsored retirement plans, which really are not retirement plans. What they really are is glorified savings accounts, and they are savings accounts that have conditions to them. What am I talking about? Well, I'm talking about the fact that in order to get whatever benefits you think you're getting in your 401k or your IRA or those other accounts, you have to give up control over your money. What do I mean by that? Giving up control over your money. Well, it means you have to agree to a set of terms and conditions, and those terms and conditions are designed to keep you from tapping into that money. They are designed to keep you from touching that money. They are designed to take your control over the money away from you. Now, why does the government do that? Because the government thinks that if you touch that money, you're going to fail. They're convinced of it. As a matter of fact, that's one of the reasons they put a 10% penalty on all of those accounts. It's designed to prevent you from tapping into that money, because you're going to sit back and you're going to go, wow, 10% of my money, that's a lot of money. And then and here's the other thing. Let's talk about the taxation on that money. That money is essentially tax deferred, meaning you put that money into those accounts and you're not charged any tax on that money, right? That money is designed to grow over time. And then when you get to the point of retirement, you tap into that money, and that's when the taxation occurs. Now, I know there's one particular type of IRA out there where it kind of works in reverse to that, but don't worry about that particular IRA. Focus on what those accounts allow you to do, and more importantly, what those accounts don't allow you to do. So the key thing is the government wants you injecting your money into those glorified savings accounts. And the reason for it is they don't trust you to be able to invest your own money correctly so that you get better rates of return than what those market accounts are doing for you. Does that make sense? I mean, I just hit you with a bunch of mumbo jumbo, but what I'm really getting at is that the government is telling you that you're ignorant. The government is telling you that they, as the government, can do a better job of protecting your retirement savings than you can do yourself. So what am I getting at? Well, I'm looking at the average 401k balance. And this is coming from U.S. News and World Report. I'm not making this up. Lifestyles Unlimited is not making this up. This is factual information that was published in the media by U.S. News and World Report. And they said the average 401k balance decreased in the third quarter of 2023 to $107,700, down from an amount of $112,400. Now, I know most of you are going to say, but wait a minute, Al, you started off the show by saying that those stock accounts have kind of broken out. They have gotten above overhead resistance, and they're in trading positions where they're trading at new highs. So what about that? Well, I can't factor what your average account is doing based on the current situation, because I don't really know what's in your particular account. All I can do is take some factual information that U.S. News and World Reports pointed out to me, and it indicates to me that 401k declined. Now, you only are affected if you take the money out of the 401k, meaning you're doing dollar cost averaging, you're doing certain things that allow you to buy additional fractional shares when the value is going down. But what if you were at a place of retirement in the third quarter of 2023? What if you needed to start tapping into that money? You would have noticed that the value of that money has gone down, and you had no control over that, just like you have no control over that account. And if you want to take money out of that account, you're penalized 10%. You're going to pay the taxes on that money, but you're also going to pay a 10% penalty on any proceeds you take out of that money, provided you're not 59 years of age, well, 59 and a half, to be honest with you. That's what the law says. And when you consider that after you pay the taxes, and I'm just going to assume the taxes are 20%, I'm just going to assume that you're in a 20% tax bracket. If you paid the taxes at $21,540, that would leave you with a balance of $86,160. Now, if you're not 59 and a half years of age or older and you tap into those funds, the government is going, well, I'm not going to say is, they will charge you a 10% penalty. That's just the way these things work out. So that penalty would be an additional $10,770, which would leave you with a little over $75,000 of investable money, or money to live off of. And if it costs you $50,000 a year to sustain your household, you would be out of money in a year and a half. Then what do you do? What do? You have a severe financial problem at that time. Now, I also understand that many of you are in a different place when it comes to these investment accounts. I've already stated that earlier, but I'm going to restate it again. Some of you are younger. Some of you are maybe within the first 10 years of contributing to those accounts, and you're on the 35 to 45 year roadmap. So maybe you're thinking, wow, the markets have recovered. I'm in easy zone right now because there's really no overhead resistance. Okay, I get your methodology. However, what you fail to take into consideration is that stock market does what that stock market does. Look what we are coming out of when it comes to that stock market. Part of the reason the third quarter returns on the average 401k balance declined was due to what was going on in the stock market. So many of you could say, yeah, but we've lived through that. We've come out the other side. Everything is good to go. Is it really good to go? What happens when the next major financial event occurs in the United States and that stock market declines? It could be a problem. Now, I also know that many of you are close to retirement age. Many of you are close to that 59 and a half year zone. Some of you are trying to war game it. Some of you are trying to think of ways to, well, outlast your current age and get it to the age of 59 and a half so that you don't have to worry about the penalty. Well, what if I told you when you become a Lifestyles Unlimited member, we actually have vendors that can help you avoid the penalty? What does that mean? It means that there's several conditions, there's several things that have to line up correctly in order for this to work, but it works very well. So what do these vendors do? Well, these vendors are attorneys, and what they do is they use divorce law in order to transfer whatever money you have in that 401k to your spouse. And it uses existing divorce law to do this. And here's the neat thing. You do not have to get divorced in order to make this work. You don't. What you do is you take advantage of what the law affords you. I'm not saying you're doing anything illegal. I'm not saying you're doing anything immoral. What I'm saying is the law is written in a certain way, and these attorneys understand how to take advantage of what is in current law to help you avoid the penalty. Pretty cool stuff, right? Now, it doesn't work if you're single, because you have nobody that you're married to transfer the value of the asset to. It doesn't work if you're divorced, because you've already separated from that person you used to be married to, right? So it doesn't work in that instance. It works best when you are happily married. Because keep in mind, you're going to have to trust that person that you're going to transfer all your wealth to. But when they transfer that wealth out of your name and into your spouse's name, it avoids the 10% penalty. Now, they do charge a fee to do that. And I'm going to estimate that fee at around $5,000. I don't really know what that fee is. But when you sit back and you take a look at what is in that 401k balance effective the third quarter of 2023, and you realize that there's $107,700 in that account, 10% of that is $10,770. I think it's more advantageous to pay a fee of, say, upwards of $5,000 in order to tap into that account. Because $5,000, even though it's a fee to get your money out, is still less than the $10,770 that you would pay in the form of a penalty. I think it's worth it. As a matter of fact, the difference between paying the fee and not paying the fee works out to be about $6,770. And I think it's worth keeping $6,770 in your pocket to take advantage of something that a Lifestyles Unlimited vendor can do for you. It may take a little bit of time to get it done, but time is kind of on your side. So what am I really getting at? I mean, I'm suggesting that you tap into this money, but what do you do with this money once you take this money out? Because once you take this money out, it's just cash. It's literally just cash. I mean, you could put it into a high-yield savings account, and that savings account could pay you, well, I think in today's current interest rate environment, it could pay you effectively 5% or higher. I know my son has got some of his money in some high-yield savings accounts that are very liquid, and the reason he's doing that is we're getting ready to buy some more real estate, but rather than have the money sit in an account that pays like nothing or maybe 0.001%, he's better off getting at least a 5% interest rate on his money sitting in the high-yield savings account. But what should you do with that money? Let's say you tap into that money and you pull it out. The condition is if you pay the full taxes and the full penalty, you're going to be looking at around $75,000 of investable cash. If you go with a Lifestyles Unlimited vendor that can help you save a portion of that penalty, really more than 50% of that penalty, you're going to have about $81,000 of investable cash. So what do you do with it? What do you buy? Do you buy single family? Do you buy multifamily? Well, that question is best answered by having education to back it up. What do I mean by that? Education to back it up. I mean exactly that. Once you're educated by Lifestyles Unlimited on how to do this, it's a game changer. We come back from the break, I'm going to get into a strategy that could work for you. Stick around.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
We sold one of my wife's properties and actually did a 1031 exchange, and we bought 3 brand new builds in Fort Worth. So right now, collectively, we have 3 of her inherited properties and then 3 properties in Fort Worth that we've done through Lifestyles.
And you turn 1 property into 3, tripling your cash flow.
Exactly.
Yep.
Well done.
Learn to increase your cash flow. Register for the workshop at lifestylesunlimitedworkshop.com.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the second half of the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, I'm working on your financial freedom. And what if I told you that there's a better way for you to invest your money than what you're doing with your 401k or your IRA or your other government-sponsored forced savings account? And they take all of your control away. Even if you invest into things like real estate from those accounts, you have no control over the money because all the money has to go back into that account. By investing in something as simple as single-family houses can change the trajectory of your life. It can get you away from being retired in, say, 35 to 45 years, and it can get you to a place of retirement in 5 years or less. So, earlier in the show, I told you that U.S. News and World Report published an article where they said that the 401k balance effective the third quarter of 2023 declined from $112,400 to $107,700. So the majority of you listening to me, you really don't know how to invest in these assets. And I'm not picking on you. I'm just telling you that it's not as easy as watching Flip This House or Flip or Flop or whatever you watch on HGTV. By the way, what those people are doing is something called flipping properties. And flipping properties is not really investing. It's really a job. And the IRS qualifies that because they not only charge you taxes at whatever your prevailing tax rate is, but they also consider you self-employed. So you have to pay 15.3% in self-employment taxes on all the gains that you make. One of the things I want to share with you is that there were 3 different properties that came across my desk, and I thought all of these different properties had some different benefits to them, and they're in different parts of the country. So what it does for us is it allows us to diversify our portfolio by geographical location, which I think is important to do if we were to buy these 3 different properties. Now, one property was built in 1971. It's a 4-bedroom, 2-bath, 2-car garage. Another property, oh, by the way, that one's in Columbia, South Carolina. The second property is in San Antonio, Texas. It was built in 1953. And the third property is in a place called, well, it's outside of Dallas, Texas. It was built in 1961. Now, I really haven't told you anything about these investments when it comes to what does it take to buy these investments. But here's the kicker. You could buy all 3 of these investments with the net proceeds of your 401k at $81,000 and still have over $12,000 remaining in the bank, and you can use that for cash reserves or potentially to buy a 4th asset. That's what's really cool about real estate. Real estate gives you the power to do some amazing things. The first asset produces a 10.88%, call it 10.9% cash-on-cash return. It returns a cash flow of $306 per month if you invest $33,750 into the asset. The second asset returns a 12.34% cash-on-cash return. In other words, it produces $216 per month in cash flow if you invest $21,000 into the asset. And the third asset produces a $403 per month cash flow if you invest $14,250 into that asset. Now, that one gives you a screaming almost 34% return on investment based on the cash on cash. And it would be really neat if we just had 3 like this third property, but you don't always find 3 like the third property producing a windfall of cash flow. So what I'm doing is I'm giving you a blended approach. I'm saying if we bought all 3 of these different properties, each one requires an additional amount of cash out of pocket. Each one returns a different cash flow, and each one returns a different return on investment based off that cash flow. But your blended cash flow rate, if you bought all 3 of these properties, works out to be about 19% return on investment. Now, some of you are saying, but wait a minute, my 401k is gone. I don't have that to rely on. And here's my point. You don't need to rely on that because now the cash is invested into 3 different assets, and those assets are paying you 5 different ways. Now, I talked about the cash flow component, right? And I think the cash flow is the most important thing for you to focus on because it's with that cash flow that we get ourselves retired. Now, some of you are saying, well, I can't retire on $925. Not a problem. I'm not suggesting that you do retire on $925. What I'm suggesting is that you use that $925 to pay for certain expenses in your household. At Lifestyles Unlimited, we call this concept chunking. So with that $925, you look at what are you paying for in your household. Let's say you have an electric bill, and let's say it's $300 per month. That $925 per month will cover that electric bill. Let's say you have a natural gas bill, and let's say that's $100 per month. That $925 also covers that gas bill. What about gasoline? Well, let's say you consume $200 worth of gasoline per month in your household. Guess what? The real estate is paying for that. Up to this point, with the three expenses that I've articulated to you, we're only spending $625. We have still $325 left. And what if that equates to the cost of your insurance for all of the vehicles in your household? Now you have three assets covering four expenses in your household, which is freeing up more money. This is how it works. And I'm not suggesting that you can retire yourself on three assets. But what I'm suggesting to you is that you can repurpose the money in your 401k or in your IRA. And by repurposing that money into cash flowing real estate, now you're going to take advantage of the money that's coming into your household every month after month. $925 can go a long way to paying the expenses of your livelihood. But what about the other ways we make money in real estate? Cash flow is just one of them. There are three other ways that are directly related to increasing the equity in your assets. Now, with these three different properties that I'm looking at, each of them has what we call an equity capture component. What does that mean? It means when we buy the asset and we pay whatever we pay for the asset, and because you've been trained by Lifestyles Unlimited to not pay full retail value for these assets, you're going to pay wholesale pricing for these assets. And because you've learned how to keep your all-in cost at wholesale pricing, the difference between your all-in cost, which is still a wholesale cost, and the retail price, which we call the after repair value or the appraised value of the asset, the difference between those two numbers is additional equity that you acquire in the property that you don't pay anything for. Does that make sense? So in property number one, the cash out of pocket is estimated to be $33,750. That sounds like a lot of money, right? But you're going to capture a net equity of $23,000 additional dollars in this particular asset, meaning that as soon as you acquire the asset, you have effectively $56,750 in the asset in total equity. And I think that's a pretty cool thing. In property number two, you're going to put $21,000 cash out of pocket, but on this particular asset, the net equity you capture is even higher at $37,750. That gives you a total equity of $58,750. You see where I'm going with this? And in property number three, this one requires the least amount of cash out of pocket at $14,250, but you're acquiring an additional almost $30,000 in net equity captured. In other words, an equity captured in the deal, meaning that you're effectively making $44,000 in additional equity. Now, the neat thing about this equity is it doesn't necessarily go away. It stays locked up in the asset, and you don't pay any tax on that equity until you sell the property. Yeah, pretty cool. Now, another way we make money in real estate has to do with something called natural appreciation. We know that real estate tends to double in value every 20 years. So how do you calculate that? Well, if you estimate that real estate goes up 3.5% per year, that can get you to the doubling effect of real estate. So you just do a calculation of 3.5% per year increase in price year over year, and you get to that doubling effect at around the 20-year mark. Another way we make money in real estate has to do with something called principal paydown. Because as a Lifestyles Unlimited member, you are taught the power of leverage. So because of that, you are getting something called principal paydown. What is principal paydown? It means that when you make that mortgage payment every month, a portion goes to interest, which is a business expense, and a portion goes to principal paydown, meaning that it's paying down the amount that you owe on that property every month, meaning that you're getting an additional equity bump in that property. It's the least way that we make money in Lifestyles Unlimited as real estate investors, but that way still keeps pace with what your financial planner told you should probably be getting in your 401k or your IRA, if that makes sense. Okay, and then there's something called the tax advantages. The tax advantages are really cool because the IRS makes us take them. Yeah, the IRS basically says in the IRS code, you will take something called depreciation, which means you're going to write down the value of the improvements on the property, even though the value of the improvements may not have gone down. They assume that the components wear out over a 27.5-year period of time. So what they have you do is take the improvement value of the asset and divide it by 27.5 years, and that gives you an amount of depreciation write-off that you take. You use that depreciation to protect the income streams that you're making on the property, meaning if you're getting a blended cash-on-cash rate of about 19% rate of return, you're not paying any taxes on that 19%. That 19% blended rate of return keeps coming in without any taxation because you are taking advantage of the tax benefits of being a real estate investor. So what if you held these assets just for 1 year and you take into account the 5 different ways we make money in real estate? What is your blended capital gain? In other words, what is your net capital gain? Let's say you sold the assets. Let's say we bought these assets today. We bought all 3 of them today, and we owned and we operated them for 1 year. 1 year and a day, because we do that specifically because the capital gains tax structure changes at 1 year and a day. If you own property for a year or less, you're subject to short-term capital gains rates. That's what flippers are subject to. That's where you pay taxes at whatever your ordinary tax rate is, and you're subject to self-employment taxes. But if you own the asset for a year and a day and you sell it, you're only subject to long-term capital gains rates, which are much more favorable than the other taxation method that the IRS imposes. So what kind of rate of return can we receive if we held it for a year and a day and we sold all 3 of these properties? My math comes out to 115% return on investment. What does 115% return on investment mean? It means that you have more than doubled your money in a period of 1 year. More than doubled your money. That's what 115% return means. And I take out the actual amount that you invested in the property. I am looking purely at the net capital gain less the cash out of pocket. That's 115% return on investment, or more than a doubling effect. What if you held the properties for a total of 5 years? What kind of rate of return could you receive? That blended rate of return works out to be 358% return on investment. You heard me correctly, 358% return on investment. You've more than quadrupled the money that you put into your assets. So what do you do at that point? What do you do? Well, after 1 year or after 5 years, you can dispose of the property. In other words, you can sell the properties. And I already suggested that maybe after year 1, we would go ahead and sell the properties. And with that money, what we do is we go out and we buy 2 assets to replace each asset that we sold, meaning you're going to trade 3 assets in, and now you're going to buy 6. So everything effectively doubles. That $925 a month that you're making in the blended cash-on-cash return, it doubles and it turns into $1,850. Imagine what you can pay for with $1,850 after just 1 year of owning real estate and then trading it back in. If you want to do what I'm doing, you want to do what the 50,000 members of Lifestyles Unlimited are doing, go to lifestylesunlimited.com, sign up for that free workshop, and let's get you going.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.